Hey traders, it's John Fortune here with this week's weekly Forex forecast. Hope everybody's having a great weekend. I have been warning, as many of you know, since March that we are coming towards the end of the business cycle, and I do believe that a stock market capitulation, as I've been saying, is going to take place in Q4 of this year. We are in Q4 now, and I do believe we have enough information to start to see how this is likely to play out. And I want to cover that in today's video, as well as looking at markets for next week. Okay, so a very quick look at the economic calendar. There is one thing to pay attention to next week. It is the interest rate decision out of New Zealand. I do like New Zealand pairs next week, and I will be looking to trade them most likely after this takes place. And so we will be looking at some potential news trades for the New Zealand dollar pairs next week. And on top of that, the only other thing to note is we do have Thanksgiving in the US on Thursday. So markets are very likely to be slow, Forex markets, etc., when the US has a national holiday. So keep that in mind for next Thursday. Okay, so if we look at the scores for the coming week, you can see that to the upside, the best Forex market is the Swiss franc, and to the downside, it is the Canadian dollar. So CAD franc to the downside is one of my top markets that I'm going to be looking at going into next week. I also like EurUsd to the upside and EurCad to the upside. Both of these were highlighted in last week's video, and both of them finished the week positive. What we do have to take into account, and last week in the Forex complex was actually a little bit slow, reason being because, as I noted in previous videos and on Twitter, we had big moves off of that CPI data in the dollar, in the Swiss franc, in the yen. And when you get big moves, 2-3 standard deviation moves in Forex, you often have a pause or a correction or a breather after that. That's exactly what we saw last week. The DXY, when we go and look at it, didn't really do much last week. And that is really the same for some of these markets like CAD yen to the downside, CAD franc to the downside. So a number of these markets are really setting up for what look to be very nice moves, but we may need a little bit more of a correction, a few days of correction heading into next week in some of these pairs as they continue to pause after those massive moves that we saw from the last US CPI print. So just bear that in mind. A little bit of patience is likely going to be required at the beginning of the week. However, outside of the Swiss franc and the euro to the upside, Aussie CAD to the downside, we are going to be looking at those pairs. Also going to be looking at Aussie yen to the downside and CAD yen to the downside, which I like, but which have been just kind of correcting last week. And we're also going to look at the New Zealand pairs to the downside vis-a-vis the Swiss franc. We're going to look at Euro New Zealand to the upside and also New Zealand yen to the downside. Okay, so let's look at the individual currencies, starting as always with the dollar index, but I want to look at this in the big picture. So as many of you know, I have been saying since March, I do think the business cycle is coming to the end. We are headed for a global recession, and we are facing a stock market capitulation in the near future. That was H2, so the second half of this year, narrowed down to Q4, which is what we're in right now. And if we look at this on the monthly chart, we are starting to see quite a clear pattern developing. Now, many of you will know I'm not a hardcore Elliott waver, and that's because markets are not always moving on wave counts. The idea you can just open the chart, read it on a wave count and know where it's going every single time is not actually realistic. Markets, they will move on Elliott waves and they will produce Elliott waves, but they are not always moving on Elliott waves. And if you have to squint and if you have to try really hard to find the waves, then they're probably not there. So I do like to use it, but I like when these wave counts jump out at me and I don't really have to look for them. And that is the case with what we're seeing in the DXY. This is not something you have to strain very hard to see. What we have here, and we have multiple rules, which this is actually aligning to for Elliott wavers. And that is that these waves develop in 5 waves, first and foremost. 1, 2, 3, 4, 5. What we can clearly see here is we can clearly see the 1 wave, which was the rally off the low. We then have an ABC for the 2. It's a deep pullback. Very often when you have second waves and fourth waves, they alternate. It's called the law of alternation. Usually wave 2 is deep and then wave 4 is shallow. But if you have a very shallow wave 2, then you can have a deep wave 4 like this. So you can clearly see 1, ABC 2, and then 1, 2, 3, sideways 4, and then a 5th wave. Then you have the pullback for the fourth wave, and then you have this correction here. So we come down, we come up, and I noted in the big DXY thread that I posted on Twitter and attached in the YouTube videos that this was likely a second wave and we were starting to break out into a third wave. And you can see we do have momentum once we broke the high, and that's exactly what you would expect to see in a third wave. And when we look at the pullbacks of these waves, this was a deep retracement. So from here to here, this second wave was deep. And now we do have the shallow retracement level for this potential wave 4 right here. And that's at the 0.382. So what I'm looking at here, and when we put all of the pieces of the puzzle together, when we align this with the macro, which is that inflation, yes, has come down a little bit in the US, but you have the Federal Reserve coming out now, and they're telling you, Bullard was even saying that the terminal rate could go as high as 7%. Why? Because very often, historically, you have to get interest rates above CPI or core CPI in order to get it down. And they are not there yet. So there is room, and I believe we could be seeing a higher terminal rate than is already priced in. All of this is bullish for the dollar. And in a stock market capitulation or a crash, you would expect to see a strong rally in the DXY. Now, if we are coming down, and perhaps over the next month or so, and we are in November now, so I am open to the idea that this gets pushed into Q1 of next year. But if we can come down for this fourth wave, it does look like we could have one final move up, this kind of blow off top in the DXY, and that would likely, in my opinion, coincide with the stock market capitulation and the crash, which will indicate the bottom in the market. Because the stock market is not going to go down forever. It will at some point bottom, but stock markets do not tend to bottom without a panic, without fear and a capitulation. And I do think, based on what I'm seeing here and in the S&P 500, that we could very well be looking at a fourth wave correction, perhaps into the previous high, down to roughly the 104.50 before that final rally into the high of the dot-com crash, which again was in the DXY thread. And we have this kind of fifth wave blow off top target here at the 121 to 125. Okay, so how does that align with what we're looking at in the S&P 500? Well, we are in an overall bear market in the S&P 500, and as it currently stands, we are in a bear market rally. Now, going back to the 50s, historically, the average bear market rally in the S&P 500 is around 15%. You can see the previous one was 19%. This was actually bigger, but the average is 15%. And 15% off the lows is the 4016 area, which we tagged and we sold off from. So what we're looking at here is we're looking at the DXY potentially coming down to the end of a fourth wave, which is a corrective wave, therefore followed by an impulsive wave to the upside, a fifth wave, an explosive move. And at the same time, we are seeing the S&P 500 now at an area where historically you would expect it to start to roll over if this is going to be an average bear market rally. When you put those two things together, you end up with two potential reversal points in opposite directions, leading to a final fifth wave in the DXY, blow off top, and a potential capitulation in the S&P 500. Okay, so let's drop back down to the daily chart and look at the near term here in the DXY. We do have this big sell-off, 3 standard deviation move to the downside in the dollar index. And I noted at the beginning of last week, downside on Twitter I posted was limited. And you can see we really struggled to break, and now we are correcting. So going into next week, I would not be surprised to see this continue slightly higher. The problem is you are, if you go long the dollar, trading this counter trend. Now that's fine. If you want to trade counter trend, you can do that. I prefer not to trade counter trend. I prefer to go and look for markets which are derivatives of that. For example, if we get a continued rally or correction in the DXY, then you could look for crude oil to the downside would be a good one, because as the dollar appreciates, this is a tailwind for oil shorts. So I would prefer to look for crude oil, and crude oil next week is a market I am focused on to the downside. But if you do want to trade counter trend, New Zealand dollar is probably the best counter trend trades you can look for, and I'm going to show you that because of the interest rate decision next week. We'll look at that as well. But before we get to the markets, quick look at the individual currencies. What I think we're probably going to see here is a continued correction. Now, this might take a few days. It may take even longer than a few days, but I think we get this correction. I think near term we get some risk off as this happens, and then I think we have another leg down in the dollar. That actually would be 1, 2, 3, 4, 5, 6, 7. As many of you might know, 7 waves is often the sign of a correction, and 9 waves is often the sign of an impulsive move or a primary trend. Impulsive moves, 9 waves are called primary trends. Corrections are called secondary trends, often develop in 7 waves. So if we have 1, 2, 3, 4, 5, 6, 7, that could also provide us with the double bottom that we could look for right in the area of that major 4th wave pullback. Now, that would suggest potentially one more high in the S&P 500. Maybe we do go to 16, 17, 18% like the last bear market rally. But I do think that is the area we really need to be looking at very, very carefully for a bigger risk-off event to take place. The next leg down in S&P 500 and the next rally in the dollar. And the dollar, in my opinion, is coming back to new highs. And as I said, I believe we could be coming up to the 121 quicker than a lot of people think. Okay, so if we look at the euro on the daily chart, the euro has actually pulled back to the 1.03750. And if you remember, this was the 7-year breakout we've been monitoring all the way through the year. We've pulled back to here, and think about this in relation to what we looked at in the S&P 500. So in the US dollar, we are at a potential 4th wave end, not right now, but maybe over the next week or next few weeks, we start to see the DXY bottoming out. At the same time, the S&P 500 is at its average bear market rally level, and the euro is sitting at a pullback to a 7-year breakout. So again, perhaps we come down a little bit further and we correct next week. Maybe we get one more high and we double top up here, and that starts the move away from the 7-year breakout. That would also be indicative of a bigger, more volatile, explosive move, because when you get these pullbacks, these retests, and you start to push away from these levels, that's when you get big sell-offs, because everybody who's trying to trade this as a bottom is going to start to panic and they exit their positions, and this causes the market to pick up momentum, gain steam as it starts to sell off. So very important to put all of the pieces of the puzzle together. The euro also fits in with what we just looked at in the dollar and the S&P 500. Next is the pound. Now the pound has been corrective ever since we had the flash crash. As I showed you in previous videos, when you have flash crashes, they tend to come up, take out the high, and then they come back over to the low. So again, this also fits in a different way for further declines to the downside, taking the DXY back to new highs and above. But in the near term, again, I wouldn't be surprised to see this pull back, test the 1.2057. I am neutral overall on the pound, but now we're starting to pull back and retest these lows over here. I would not be surprised to start to see this roll over if the DXY does turn around as well, like discussed. Next is the Swiss franc. We took out the previous target at the 1.07010. Now, when we look at the Swiss franc, does the Swiss franc confirm everything else we've been discussing in the euro, in the S&P 500, in the dollar? The answer is yes, it does, because in the Swiss franc, we had a 5% rally which erased 50% or half of the entire year's move to the downside in the Swiss franc. These are moves you tend to see. This is the kind of volatility you tend to see around big market events. And with the Swiss franc rallying, what this is setting up in the Swiss franc is a potential right shoulder, and maybe the Swiss franc corrects as the dollar comes down a little bit further. And if we get this right shoulder, because this is a low, this is a lower low, and if this becomes a higher low, that would be the right shoulder. That is your precursor, and look at the momentum here. Momentum precedes price. That is your precursor to a potential third wave in the Swiss franc. What would you expect to see in a stock market capitulation or a blow off top in the dollar, a flight to safety? You would expect to see a sharp rally in the Swiss franc. So keep an eye on this. I believe this is also confirming what we've looked at in the other markets. Next is the Japanese yen. Big steep rally, and it does look like we need a bit of a correction first. That's why I say in CAD yen, for example, Aussie yen, maybe patience required as the yen corrects a bit further, but I am looking for the next leg up. And again, we are potentially looking at an inverse head and shoulders reversal pattern in the yen. And when we look at the yen as well, the Japanese yen rallied 6% on that CPI data. And I noted previously the last time it did that was during the 2008 crash. That was the last time we had such a rally in the yen. So again, volatility to the upside in this safe haven asset, which you only tend to see around large risk-off events. Next is the CAD. The CAD is correcting. The bigger move is to the downside. And again, if we come down in the dollar a little bit higher, I would not be surprised to see this come up and double top. But overall, the Canadian dollar is one of my preferred shorts. And if we do push a little bit higher next week, again, patience might be required in CAD franc, for example, as it continues to correct. But the bigger move we should be focused on is to the downside. And if you're going long the Canadian dollar, the problem you have is you may only have a little bit of reward to the upside, but you could end up missing the bigger move or being on the wrong side of the bigger move, which would be even worse. So I do like CAD shorts, but patience may be required if we push a little bit higher first. Australian dollar, exactly the same as the CAD. Big rally up, and I would not be surprised to see this correct a bit, rally into the highs as the DXY corrects and then comes down. And then I do believe this could be where we start to see the Australian dollar rolling over to the downside for the next leg down and onto the 0.61240. And finally, the New Zealand dollar, a steep rally to the upside. And we have on the 4-hour chart here, this is a small double top. And I would not be surprised to see this correct into the interest rate decision. Why? Because very often leading into interest rate decisions, markets correct because big players are not placing their money in the build up to this, and you just see accumulation in these markets. And that's one of the reasons why, if you did want to trade the US dollar counter trend, it would be the New Zealand dollar, which I think could set up a good trade into the actual interest rate decision itself, because if the dollar corrects, and the New Zealand dollar probably is going to correct leading into the interest rate decision, this move from here down, this correction into the interest rate decision, gives good risk to reward, because it's unlikely you're going to get an explosive move to the upside, but you could actually see this snapping back before the interest rate decision. Overall, I believe all three of these commodity currencies are set for a next leg down fairly soon. I do believe they're coming down to their lows, and again, I think this actually confirms what we've been discussing in the other markets. Okay, so let's look at the markets themselves, starting with crude oil. Crude oil is one of my favorite markets heading into next week. We had a really good sell-off into the 80.02 last week. Coming into this week, if we do continue to correct in the DXY, instead of trading any of those markets counter trend, this should put downward pressure on crude oil once again. And any pullback in this market next week, I am looking for potential shorts down to the previous low and then onto the 74.23. As I said, this is one of my favorite markets heading into next week. Next is CAD franc, a huge sell-off, and this is why we've had the near-term correction, the pause. So as I said, patience may be required if we are going to get a little bit of a deeper correction, but the deeper the pullback, the better. Because if we pull back and we have a deeper correction here, then it gives us more room to the next target, the 0.7061. So any continued correction is simply viewed as an opportunity to start to look for shorts into the 0.7061 and then onto the 0.6930. Next is Aussie franc. This was a market highlighted to the downside last week. And you notice the markets highlighted in gold, CAD franc, Aussie franc, EurOcad, EurAusd, CAD yen, Aussie yen. These are all risk off setups. So if we do get a continued correction in the dollar, these markets should benefit. I did highlight this last week, but not too much happened. We came back and we retested the high over here, and it does now look like we could be coming down. So any continued pullback is simply viewed as an opportunity to look for shorts down to the previous low and then onto the 0.6208. Next is New Zealand franc. Now, I'm looking at this in the daily because I think it gives a clearer picture of what we're looking at here. You can see we came back and we retested the lows over here, and now we are forming a double top. I would not be surprised to see this coming up, trying to push through the highs once again. And if this starts to fail, especially if we test the highs, and then we get a sell-off on the interest rate decision itself, this is a market I'm going to be looking to after the interest rate decision for a potential follow-through down to the 0.5512, which, as I've been saying, I do believe is a high probability target. And all of this as it stands should just be treated as a near-term correction. A sell-off in New Zealand franc is, of course, risk off. And I do think the interest rate decision next week could be the catalyst to push this down to new lows. Next is EurOcad. EurOcad was a market highlighted to the upside last week, and we did come up and take out the 1.3806. As you can see, EurOcad is quite extended, so I would like to see this correct first. Any pullback like this would be treated as a bull flag, and an opportunity to once again look for long positions into the 1.3890 and then onto the 1.3976. Next is EurAusd. I highlighted this market last week, and because the dollar didn't really go anywhere, a lot of markets just kind of corrected. It was a bit choppy last week. We had quite a low volatility week. But we are forming now an inverse head and shoulders. We do have this momentum rally. Momentum precedes price. I am looking further advances this week. So any pullback in this area, especially if we can come back and test the left shoulder, I am going to be treating this as a bull flag and an opportunity once again to look for longs into the previous high and then onto the 1.5839. Next is euro-dollar. Now we look at euro-dollar every week, but I think euro-dollar probably does what we've looked at in the DXY, just the inverse, of course. And because we're right up at the 7-year breakout, I would not be surprised to see this correcting a bit more, especially as we have a kind of shallow correction here. I wouldn't be surprised to see this get quite deep as the DXY corrects that 3 standard deviation move. And then if the DXY comes down one more time like this, that would be the opportunity to look for a rally in euro-dollar to the previous highs, and that is where I'd be looking for a potential double top and the DXY in the bigger picture to start to bottom for that fourth wave or the end of the fourth wave. So going into next week, the problem is you would probably have to look at this counter trend because it does look like we have a correction continuing in the DXY next week. If we break this, we can look up to the 4-year breakout, the 1.06359. I don't think euro-dollar as it currently stands is a great market to be involved with. Next is Euro-New Zealand. Again, highlighted in blue because these are post-interest rate decision trades that I'm interested in looking at. What I'd like to see here is you can see we have this big bull flag. If on the interest rate decision we get a strong move to the upside, I'm going to be looking for a pullback, and then I'm going to be looking for the follow through into the 1.7539 and potentially higher as well. But the first near-term target is the previous high at the 1.7539. So again, interested in this after the interest rate decision takes place if we get a rally and a break higher off of that interest rate decision. Next is CAD yen. Now again, looking at this in the daily chart. Why? Because normally we look at these in the 4-hour chart, but we have to keep in mind the big picture because a number of these are showing major reversal patterns. Discussed in last week's video how a number of these yen pairs are setting up for, in this case, a large head and shoulders, a high, and then a lower high. And the break of here is actually the confirmation. As you can see, we're currently just correcting 1, 2, 3, 4, 5. We did nothing last week, so the analysis on this remains the same. Any pullback here is viewed as an opportunity to look for shorts down to the 101.76. However, if we come and re-break this low after confirming this head and shoulders, we could see some very strong momentum to the downside because that is when these markets tend to turn into third waves. Next is Aussie yen. Now outside of CAD yen, Euro Aussie, EurCad, Aussie franc, CAD franc, those are my 6 favorite markets going into next week. Again, on the daily chart, so we can keep an eye on the bigger picture. We do have this head and shoulders reversal confirmed on a breakdown below here. So any correction is simply viewed as it currently stands as an opportunity to look for shorts into the low over here and onto the 90.53. But just like CAD yen, if we break here, we could be seeing a third wave coming into the downside. And as I said in last week's video, this is indicative of a large risk-off event. And the final yen pair is New Zealand yen. What I would like to see is if we can push a bit higher and then reverse on the interest rate decision. If we start to reverse and we get a bigger sell-off, this is something to pay attention to. High, higher high, this would be a failed high, in other words, a lower high. And any sell-off with momentum to the downside as a catalyst, look for this pullback post-interest rate decision because that could very well be the catalyst which sends this back down to the lows. And if we break the low down here, that is, again, potentially the start of a new trend, a third wave to the downside, and indicative of a big risk-off move. And the final New Zealand pair is New Zealand dollar. This is just simply what I was looking at as a potential kind of range trade. So you're trading a lack of volatility, essentially. You have the New Zealand and the dollar. If the dollar is continuing to correct, this is likely to put downward pressure on the New Zealand. And New Zealand dollar is probably going to correct anyway, leading into the interest rate decision. So from Monday into the interest rate decision, there is potentially an opportunity here. You see how we're failing at the previous highs? We have a mini double top. I would not be surprised to see this pulling back for a couple of days into that interest rate decision. So if you wanted a US dollar pre-interest rate decision trade or New Zealand dollar pre-interest rate decision trade, you could look for this. If you hold it through the news event, of course, you're taking on that risk event. And so if you want to trade this more conservatively without taking on that risk event, wait for the interest rate decision to take place, and then if you get the sell-off, then you could come and look for the follow through trade to the downside, because again, I do think we're coming down to the lows in the near future in this market. Okay, so wrapping up the video with gold, silver, and Bitcoin. Starting with the gold-silver ratio, you can see we do have this bear flag. So I do favor silver outperforming gold as this comes lower, probably down to the 78.62 in the near term. If we go and have a look at gold, I do think gold comes up and tests the 1807.16. And if you link this in with what we've discussed in the DXY, that's essentially a continued correction, because this is a very strong move. And that would be as the DXY continues to correct like this. And then a test of this level, this high over here. That move in gold is the move I'd be looking for to the upside once the DXY correction is over. As DXY comes down, I'd be looking for the double bottom, the end of the fourth wave, as we looked at earlier. And as the dollar starts to rally, I do think this is where we could start to see gold selling off. And that could actually be the start of the bigger leg down in gold. But I do think there's one more up as the dollar comes down one more time first in gold. Next is silver, very much just the same as gold. So any continued correction as the DXY continues to correct in the kind of bear flag that it's currently in, I would be treating this as an opportunity to look for longs into the 22.49. But as the dollar starts to come down, test the lows, if we do start to double bottom here, that's where I think this could be the start of the next leg down in silver. And last but not least, we have Bitcoin. As the dollar sold off, did we see a big risk on move coming into Bitcoin? No, because we had the FTX debacle. And so we are seeing a general risk off sentiment throughout markets despite that sell-off in the dollar. Any pullback in Bitcoin, we did have this big sell-off. And again, when you have big sell-offs, you get the correction. So any pullback in Bitcoin, patience is required, but any pullback is viewed as an opportunity to look for shorts into the 14,858.30. So that is it for me for this week, guys. As always, I hope you enjoyed this video, and if you did, please let me know by liking, sharing, and subscribing. A big thank you to everybody who does that on a regular basis, and a big thank you to everybody who has subscribed to the channel so far. If you enjoyed today's video, why not consider joining us during the week, where I share my charts as well as the setups that I'm personally looking at trading with members on a daily basis. And we also publish the scorecards for over 75 markets in different asset classes, including Forex, stocks, bonds, and commodities. You can find out more about the benefits of GMT membership by clicking the links in the description below and also in the pinned comment below. So thanks for watching. The only thing left to say is take care and don't forget to trade safely.